You know, we're in the midst of a remarkable rally, but today, for the first time since President Trump has taken office, I saw the market move on panic buying. Now, the first sign that this could be a huge day was the initial reaction to that jobs report, which saw the Dow sort of edge higher after it was reported that 148,000 jobs were created in December. Let's be honest, that's 100,000 less than most Wall Street firms are expecting. Forget about the official estimates. Most people thought it was going to be a lot higher. But when the market opened, stocks began to drift, and then it started to look like, you know what, this is going to be one of those sessions where investors are going to just be thrilled. Hey, solid first week, head home, hunker down against this Arctic blast covering the nation. And then it happened. Right around 2:21, the Dow started to take out some intraday resistance points that had rebuffed rallies several times, and in the process began to trigger a series of buy signals, right? Of course, from there, buying begat buying. The Dow Industrial Average then soared into the close, in fact, closing at the highest level of the session as the closing bell began to ring. Now, the result of this frenzy is the best first week for the stock market since 2006 and the 74th record high under for the Dow under Donald Trump. The first week of trading is a pretty good harbinger of things to come. In fact, historically, 68% of the time, as goes the first week, so goes the rest of the year. Now, this morning on with Maria, I mentioned that the jobs report was, quote, a Goldilocks numbers, not too hot, wasn't too cold, which is important when one of the few challenges really for this rally this year will be Federal Reserve action. And for the record, I think the Fed is going to play ball, not derail the rally, in part because their official inflation number is going to remain below their level of concern for a very long time. Moreover, when Janet Yellen hiked rates back in December of 2015, just sort of to prove that she was independent from Wall Street, the first week of trading in 2016 saw a $2.3 trillion loss in global equity markets. So what was the message of the market today? Well, once again, the only sector under pressure were utilities. You know, those safe stocks generally set aside for widows and orphans. They have been under a lot of pressure for weeks now. Wall Street is now determined upside potential for 2018 is just too great to ride it out in high-yield stocks. Indeed, the train has left the station in 2017, and now it is picking up momentum. It is a locomotive, and investors are still looking, though, to buy on dips and indices and individual names. The tech sector, for instance, right, the best performer today, but the best individual stock was Western Union, which has been lingering around in takeover rumors for some time. It popped pretty good today. Then there's consumer discretionary. Again, the strong performer there, CarMax, okay, bouncing off the bottom of a trading channel, people looking for value. And by the way, speaking of consumer discretionary, while stories of stores closing like Sears and Walmart made Main Street media headlines all day long, that's all the Main Street media talked about, in part, let's be honest, to sort of deny the Trump economy. The modern day gauge for consumer spending, we're talking about shares of Amazon surge to a record and again closed at the high of the session. Of course, my two favorites, materials and industrial names, continue their steady rally higher. For those who are out there sort of waiting for a significant pullback and a correction, I continue to say that I think you're fooling yourself. Of course, there's going to be pullbacks and corrections. It always has been since the beginning of time. But right now, the underlying fundamentals of our economy are just too strong to bet against this locomotive or wait for it to derail.